Perfect.
That's showing up on your end?
Yep.
Great.
Jordan, just remind me, is everybody muted and locked muted? So they can only do questions through Q&A, or can they speak?
Let's see. They should, yeah, I think everybody's muted. Oh, here we go. Yeah. Okay, everybody's muted now. There we go. Still learning the Zoom webinar platform. Haven't really used the webinar piece before, so awesome. All right, so yeah, we'll get started here. It's 1 o'clock. You're still able to see the, no?
Okay. I couldn't unmute myself. So can the audience unmute themselves or no?
I don't think so.
Okay. So then if people have questions, throw them into the Q&A. I'll track the Q&A. Don't use chat, use Q&A, and we'll answer those questions as we go.
Awesome.
Can one person just as a test throw a question up in the Q&A, please? Anyone? Perfect. Thank you, Wendy. Thank you, Carly. Okay, we're all good.
Looks like we're rolling. Perfect.
Yeah, perfect. We're all good. Okay.
And you can see my like the presentation screen, everything.
Yep, you're good to go.
Excellent. All right. Now that we have all the tech issues sorted out, thanks everybody for standing by with that. And welcome to today's CGIB CHIP session. I'm joined here today with Dave, and we have a pretty exciting session here for you. A lot of good stuff to go over. And yeah, hard to believe we're 1 year in now on this CGIB CHIP plan, and we've seen a lot of really great success. And so we'll jump right into it. So first things first, we'll talk a little bit just briefly about the renewal here. We did a little bit of a communication back in, I think, early August on the renewal when it came out, and it looks really, really good. So the total premium we're seeing in the pool right now is around $87,000 annually, and the total paid claims that we were paying out in that first year was around 50,000. So really nice, healthy balance there. And we're seeing a 2% increase to the pool rates, as was advertised in the most recent renewal document. So for pharmacare and non-pharmacare provinces, these are the new rates moving forward. The CGIB CHIP calculator on the members own page has been updated to reflect the new ratings. And when you request a CGIB CHIP proposal from BBD now, you will be getting the newly updated rates here. So really, really well done. And thank you everybody for your support in year one. Greatly appreciated. Here's to many more. So, you know, as we've continued to build this solution out over the course of the year, we've added a few resources to the CGIB website that you can access by logging into your CGIB account. If you hover over the members only segment of the page, you can see towards the bottom of that list, there's a CGIB CHIP plan page. And then there's also a CGIB CHIP calculator page that you can access as well. So we've got everything there from case examples to FAQs, field underwriting guides. We've got a very comprehensive budgeting calculator that does represent real-time numbers. So it's a really easy tool to use if you're, you know, sitting in front of a client, either virtually or in person. And we have a really great employee rollout presentation that we've developed to help advisors that sell the CGIB CHIP plan communicate it that much more effectively with prospective clients. So lots of good stuff on there. If you haven't had the chance to check it out already, I definitely recommend you do so. So jumping right back into it, the CGIB CHIP plan, as we know, it is a fully pooled catastrophic hybrid insurance program. So we're offering true insurance protection for the items that really need that insurance protection. So think high cost catastrophic drugs, maybe trips to the hospital, out of country claims, that type of thing. We've developed one set of rates. So as you saw earlier, we have a set of rates for pharmacare provinces and non-pharma provinces. Pretty easy to explain. And then if the client's looking for something with a little more cost control or some predictability in their rates, this is going to be a good solution for them, seeing as it is a fully pooled solution. We're pooling the risk together, as we can see with that first renewal. It's a pretty stable pool. And then they have that element of the healthcare spending account to really take that element of cost control and predictability that much further. Dave, is your mic working, or are you still?
It is
okay,
now.
Perfect.
Whenever I mute it, it locks me into being muted and won't let me unmute. So I'm just going to keep it open and I'll just stay quiet.
Good.
I'll try. Good call. Thanks.
I mean, no harm, but awesome. The one thing that really sets this program apart, and we've kind of reiterated this over and over, is that it's fully pooled. There's a lot of fully pooled programs out there, but the element that truly sets it apart is that it is transparent. We're really telling the advisors, hey, here's how much dollars is being collected, and here's how many dollars of claims are being paid out within the pool.
And although Jordan said there's lots of plans out there, the Chamber Plan and Sirius and several others, most of them actually have pools within pools of good, bad, ugly. So there is not quite a full pool. It does somewhat experience rate a little bit. And that's ebbed and flowed over years. So that's pretty unique too, the fact that everybody's in the same pot.
Yeah. And another piece to this is that it's really not an easy plan to market. You have the layer of, you have to be a CGIB member to sell the plan, but also it's just a very unique plan in and of itself. So from a client retention standpoint, that's another kind of key factor as well here with the CHIP plan. And like I just mentioned, only available to the best advisors in the business. So something to be mindful of there. So who's the ideal client for this type of a program? Over the course of the year, early on, we saw a lot of kind of white collar, more professional industries being quoted and sold, but we've kind of seen it really work for all industries, be it retail, construction, healthcare, professional. So it's a really, really good fit for a lot of different types of businesses. Obviously, a client that's open-minded and they're looking to kind of change up how they do things, if they're wanting a different result, if they want to offer something new and different, this is a really good type of program to consider. If they want to offer employee flexibility, maybe they haven't, it's a multi-generational employee workforce, you're going to have varying needs depending on the different demographics of the group. Again, this is a really good program to really help meet those different needs with that element of the healthcare spending account attached with the coverage. Groups with current coverage, we definitely look at, but we want to make sure that they're nice, clean groups. We don't want any, this pool isn't meant to take on groups with existing, catastrophic claims. It's meant to protect against the incidence of a catastrophic claim hitting the plan. I think Dave put it pretty bluntly when he said, we're not providing protection for the barn that's already on fire. We're providing protection for the barn in case it does catch on fire.
Just a little quick note here. I know, Aviva, you got your hand up. Can you just throw your question in the Q&A and we'll get it answered for you. Back to you, Jordan.
All right. And what we're really wanting to do here is protect the big, bad, and ugly, right? We've seen it before on small group cases in that 3 to 10 segment where a catastrophic drug claim could be very detrimental to the sustainability of a plan. So we've created a CGIB CHIP product here to really help with those types of instances.
If I can throw one line in here, we've kind of gone back in time a little bit. It used to be that insurance was for low incident, high cost events, originally disability and life insurance, and then evolving into health and dental and so on. What we've done is kind of gone back to the old days of we're covering insurance for the insurance stuff. So life and disability, maybe CI, short-term disability. and then using the catastrophic coverage, the CHIP plan for the catastrophic stuff, and then health spending account for the day-to-day. So you're kind of taking a step back to go forward.
That's a good approach. Awesome. So first and foremost, just getting into eligibility requirements. If you have a prospect, you're looking to quote this solution on. So same as our standard underwriting guidelines, they have to be at least a year in business, at least 3 employees, full-time employees working at least 20 hours a week. Groups that have current coverage in place already, we would definitely need to do a claims experience review. So, claims experience no older than 6 months. Current renewal rates is what we would require on our end to quote. The group has to have at least a minimum of $100 in monthly premium to put the group in place. And of course, you have to be an active CGIB advisor or CGIB member to quote on the case. So when you're submitting your RTQ, it's just as simple as identifying, I'm a CGIB advisor. I would like a quote on the CHIP plan.
Can I just interrupt just for 1 sec? Just a couple of questions. And so
Sure.
I've been answering a bunch of these questions in the Q&A. So I'm assuming that everybody can go to the Q&A questions and see them. But one just asked for a little bit more information about pharmacare and non-pharmacare quotes. And so what we did was we had to come up with, we wanted a common price structure across Canada. So we kind of started with that. But provinces like BC, Quebec, and is there one other one? I can't remember now.
Saskatchewan's another pharmacare province.
Yeah. So they actually end up being first payer for drugs. So they end up with a better rate than the other provinces. So when you use the CHIP calculator, you pick the province and everything else, it'll automatically grab the right set. And as that evolves, like if we ever got Trillium to be coordinated in Ontario and first payer the way it was meant, oh, okay. So I'm sorry, everybody. I just got a note saying only the host and panelists can see the questions. So, and I've been saying share them publicly. So
maybe the chat is the better place to put them. I don't know.
Yeah, not normally. Okay, so let's, oh, Mike McClanahan says you can see both. Okay. We'll come back to those questions then. Mike, you might be just because you're inside People Corp that you can see it. I'm not sure, but
there's a few others coming in that can actually see them.
Oh, okay. So there you go. So if you look at, there's open and answered, I think. Just look under the answered ones. Okay, Jordan, you go. I got to clear all this stuff.
Okay. Sounds good. We'll jump right back into the presentation here. So positioning CGIB CHIP. So a few different ways when you're talking to your prospects to kind of, help them kind of see the value in the solution. One of the big ones is that the employer actually gets to control the costs and the inflation here to really mitigate any kind of surprises at renewal. So with that healthcare spending account piece in particular, the employer is controlling exactly how much at a maximum their benefit spend is going to be for a year. And I think on the most recent podcast that Dave and I did, the question was asked about, is this plan in inflation? Is it going to handle inflation well? And I think it does handle it well because claims are made in real time with the healthcare spending account, and there's no real factors being set to account for inflation to rates or anything like that. So it is a pretty good sustainable solution when you're positioning it from controlling costs perspective. If you have a prospect that maybe they're looking to just start out with an HSA, this is a really good way to kind of add another layer or an element of insurance catastrophic protection at a very low cost, just to take their HSA that much further. You could ask the question, like, what's your strategy for covering high cost claims when they arise? Is there any kind of strategy in place for that? So another good positioning point. Another good way, if you have a client that's leaning more towards like a traditional type of benefit plan, you can ask, are you prepared to handle any potential substantial rate increases? Obviously, depending on what the claims experience does, but in the case that a high cost drug does arise, or there are a lot of claims being put through the plan, are you able to handle those rate fluctuations from year to year? So another question that you can ask the prospect when you're doing your discovery. Another question could be, do you want to do more of the same, or do you want to do something different, right? Attraction and retention of employees is a really hot topic in the job market right now. And so if you're meeting with a prospect and they want to really stand out from the competitors, are you going to lean towards more of so what other employers are doing, or do you want to look to do something a little bit different here? So another good solution for that as well.
And these come around because we've had so many of the same questions over and over again from CGIB members saying, okay, this doesn't fit on a spreadsheet very well. How do I sell this? Why would I go out and just quote this versus traditional plans? And you may or you might not. But these are the questions that we get hit with kind of over and over again. So they're probably the most common ones.
Yeah, awesome. And to kind of take hit on that point of high cost drug claims in small group, I thought I'd pull some data from the CGIB pool, which is pretty astounding. When I first looked at it, I didn't realize that the numbers were as high as they were. But when we look at the last kind of year or a couple of years in as far as high cost drug claims activity on benefit plans go, we can see that there was from 2016 to 2020, there was about a 35% increase of plan members in that 10,000 to 32,500 claiming range. And so important to note here as well, just to kind of go off topic a little bit, but the way that this pool actually works is that the insurer EP3 pool covers the first $10,000 after stop loss up to 32.5. Anything 32.5 and over goes into the industry pool, which is the Canadian Drug Insurance Pooling Corporation, CGIB. So something to be mindful of when we say industry pool, there's actually kind of two pools working in tandem. Dave?
Three in a way.
Oh,
so,
three, okay.
Right? But no, you're right. But we have from 1,000 to 10,000 is the CGIB CHIP plan pool. And then from 10,000 above to 32.5 goes to Green Shield, and 32.5 goes above if it's a repeating claim after the second year. So, I asked Jordan actually to hit on that, and he realized it too, because so many people call the EP3 pool.
Uh-oh, Dave, you have frozen.
Pool, the industry froze. You froze too for a minute. That's
Uh-oh.
funny. So did I'll just say it again. So there's been lots of questions around what is the industry pool, what's the EP3 pool. EP3 is the insurer pool. In this case, it's Green Shield, and then the industry pool is the CGIB pool. So just to clarify that one.
Awesome. Thanks, Dave.
No problem.
I think one of the most staggering statistics too is just seeing how much growth is happening in the $400,000 to $1 million range as well. I know it's probably very rare that we see these on small group, but it can happen, right? So what's the solution when that does come up?
Let me just jump in, and I know some people aren't seeing all the questions, but this is a great one. So there was a question to say, are only 6 people on a $1 million plus drug claim in the whole CGIB pool? That is right. So there's a couple of reasons for that, because everyone's going to think that's a low number. First of all, you have to be on that $1 million plus drug for more than 2 years to get into the pool. So that's threshold number one. Number two, the CGIB pool only covers insured plans. It does not cover ASO plans. It doesn't cover health spending accounts. It doesn't cover anything but pure insured plans from those original, I think it was 22 signatories, the insurance companies and Green Shield. And I say Green Shield because Green Shield isn't effectively an insurance company, but a claims payer. And so, yes, there aren't that many. So there's lots more than that are over $1 million, but many of the drugs that are over $1 million and the ones coming out are gene therapies. They're 1.2, 1.3, 1.5 million so far, it looks like, from the US pricing and so on. Those drugs will never qualify for the industry pool because they're one and done. You are cured, kind of like hepatitis C drugs, $136,000, but you're done. So that high cost claim never makes it into the CGIB pool because it never has that second year going on.
Awesome. Great answer. Thanks, Dave.
Great question. Thanks, Sam.
Thank you, Sam. All right. So moving on, now that we've got some of the statistics out of the way, we'll jump into just a quick plan design review. A lot of you may be familiar with this, but for any newcomers, it's a good refresher. So basically what the CHIP plan looks like is it's a high deductible plan. So it's $1,000 single deductible, and it's a $2,000 family deductible. So the way the family deductible works is that the plan member themselves has $1,000 that they need to satisfy before their insurance kicks in. And then any spouse or dependent or combination of the two have up to $1,000 that they need to satisfy on their own before they have access to the catastrophic insurance coverage. So if the plan member hits it before the spouse or dependent hits it, they'll have it, but they, like the spouse and dependent, won't. So that's very, very simply how that family deductible works. And of course, once that deductible has been hit, you then have 100% coverage for the items listed here. So, your prescription drugs, any medical equipment, supplies, that kind of thing. These expenses can also be used towards satisfying the deductible as well. Also important to note that the travel benefit that's included with the CHIP plan isn't subject to the deductible to get coverage. That is payable from first dollar. So something to keep in mind there. And then you have the healthcare spending account for those day-to-day items that Dave was alluding to a few minutes ago. So anything like, your parameds, your vision, dental, orthopedic shoes, anything that obviously the plan member sees fit. But I also put here, prescriptions under the deductible, and we'll talk about what that auto coordination piece looks like in a little bit. But that's another really, really good way that plan members are leveraging their spending account.
Can I just read one out? Because I know this one's come up so many times, and
Sure.
you did go okay, but we're going to hit it again. So the question is just some confusion around the couple deductible. I've been told 1,000 per couple. No, it's 1,000 per person. And so I guess we should clarify, this is the same as any deductible in any plan. If you have a 2550 deductible, 5100 or 1,000, 2,000, the first person in the family that hits 1,000, they then have 100% coverage thereafter. If it doesn't matter whether it's the employee is the first person, their spouse or their child, it could be any one of them, and that would be the deductible. If nobody else in the family has any other claims, then it's $1,000 deductible, even though it's family. Okay, so to clarify, if you had one person that had a $10,000 claim and they're set up for family coverage, there is not a $2,000.
And he froze again. Give it a couple seconds here.
Or family deductible. You got no?
Oh, yeah. You froze again. I'm
sorry.
There.
I'm getting an unstable internet connection here, but so it is always. Can you hear me now? Okay, Jordan.
Yeah.
So it's $1,000 per person to a maximum of 2,000. Maybe that's a better way to say it. So so that's what you got to know. If you have somebody who's got 12 people in their family, $1,000 per person. So first person uses it, you hit the limit, you go, it's 100% above. Second person, you hit the 2,000, you're done. Next, there's no deductible. Does that help? Hopefully. And there's like a whole bunch here. After the deductible threshold is hit and still have HSA available, does the drug catastrophic kick in and the rest of the HSAs used for other expenses? So the employee always gets to decide how the HSA is spent. So let's just presume, and Jordan's going to go through some examples, but presume that the person is just a single person and they have no other coverage, no spouse, no nothing, just simple and single. They can say all my claims that are declined by the deductible, so under the 1,000, would be auto adjudicated to the health spending account. So you could use up your health spending account to fulfill your deductible, or they can say, no, I don't want to do that. I'll submit it and have it declined. That's fine. And you're then eroding the deductible. And I want to use my health spending account all for my dental care. Not a problem. That's fine. You can do that too. So they get to choose by kind of ticking off auto coordinate or not, and which order they do things.
Awesome. Great question. Thank you. Didn't get the name on that one. It's an anonymous attendee, but thank you. So yeah, we'll get into a little bit what that plan member experience looks like. So as Dave was kind of alluding to there, the auto coordination with the insured element. So, there's going to be a lot of instances where the annual deductible just hasn't been reached yet by the plan member. And I think the most common scenario is going to be at the pharmacy. So basically what the pharmacy experience looks like under a arrangement like this, like CHIP, if they haven't hit that deductible yet, they're going to get a note at the pharmacy that says deductible not yet reached, eligible for HCSA. And so this is where that auto coordination piece comes in. So by default, when you set up a CGIB CHIP plan at BBD, auto coordination with the healthcare spending account is automatically turned on. So the employee would actually have to go in to turn it off. So it's just automatically set up to auto coordinate. So basically what that means is when they go to the pharmacy and they go to submit their claim, it's going to be declined through the insured component, but it's automatically going to kick over to the healthcare spending account for reimbursement. So the plan member is going to be out of pocket that day for the claim, but they'll be reimbursed about, typically 2 to 3 business days later through Green Shield, because the claim was auto adjudicated at point of sale to the healthcare spending account. So that's why it's critical that this plan is paired with a Green Shield healthcare spending account for that auto coordination piece. We're really trying to avoid employee double adjudication here and just really make for a more seamless overall experience, avoid the manual workarounds.
If I can throw one comment in there, if you used another carrier, then the people would have to submit one claim to the deductible so that they would be using up the deductible, and then they'd have to submit to the second company. And I always feel like when it comes to doing multiple steps, we as humans just tend not to be as good at it. So that's why we're really trying to avoid that double adjudication, so that when somebody does have a higher claim or they're over the $1,000 cumulatively of eligible claims, they don't have to go back to all their past receipts and prove it. No, it's already there. And then at point of sale, it would kick in instantly and pay for everything right at the pharmacy or whatever.
Yeah. Awesome. So we'll get into some case examples now of what this plan looks like in action. So to kind of kick things off, we'll take the example of, and this example can be applied to either a single plan member or a plan member that's opted for family coverage where there's no spousal benefits at play. So keep that in mind. But we're going to look at James here. So James has a ongoing prescription of $650. He pays his $650 out of pocket at the pharmacy. Because he has his auto coordination with his spending account turned on, that $650 is automatically bounced over to the spending account. There's now $350 left towards satisfying his $1,000 deductible and a $350 balance left in the HSA, assuming we're using a $1,000 spending account here. So on the second visit, same claim cost, $650. James is now out of pocket $350. The $350 is auto submitted to the healthcare spending account, but now that other $300 of the $650 claim is now automatically covered at the pharmacy through the catastrophic insurance component, because that $1,000 deductible has been reached. And he's used his healthcare spending account to help kind of satisfy that deductible. So similar to the example we were talking about a little bit earlier, this is a kind of a real life use case as to how that would work. So $0 balance left in the HSA. And now, any subsequent visits that James makes to the pharmacy for this prescription, it's going to be automatically covered 100% through the catastrophic insurance program for the remainder of the year. The deductible does reset every year, so something to keep in mind. But for the remainder of this year, James is good to go. He's fully covered. So now we'll look at an example of where there's a plan member that's opted for family coverage, and there's also a spousal benefits plan at play. So this is going to look a little bit different. So the CHIP plan would actually be the first payer here, and then the spousal benefits plan would be the second payer. So in instances like this, you're going to want to actually make sure that auto coordination is turned off. Auto coordination with the HSA is turned off, because the spousal plan and the CHIP plan are going to be handling the claim coverage together. And it'll just allow the family to take their spending account dollars that much further if there's a spousal benefits plan at play. So
the thing to remember there basically is health spending accounts should always be the ultimate last payer. So there could be multiple other payers in there as well. You could have, like, if we say, his and hers, his plan pays for hers plan pays for hers. There might be patient choice cards, patient support discount programs, and then health spending account last, because we want to use up all other sources of funding before going after the employee's health spending account or making them spend it. Go ahead.
Awesome. So we'll get into what this example would look like. Again, since it's an ongoing drug here that James has, $650 claim. So it's declined through his CHIP plan because the deductible has now reset. It's a new year. So the claim automatically gets bounced over to the spousal plan, assuming that the spousal plan is covering at 80%, which is pretty typical for benefit plans. The claim would be paid back out to James at $520. So the out-of-pocket cost to James in this scenario would actually be $130. So he can actually take that $130 remaining and submit to his health spending account for full reimbursement. So now there's only $350 left towards satisfying the deductible for the year, same as example 1, but now $870 instead remains in his HSA because he's using that spousal plan to pick up the differences. So refill number 2 comes up for the year, same cost. We have the $350 owing on the deductible. The $300 reimbursement has now been received from the CHIP plan because that $1,000 deductible on James's end, the plan member's end, has been satisfied. So $350 of the claim goes over to the spousal plan for reimbursement. But it's actually important to note that the spousal plan will see the full cost of the claim. So it'll actually see the $650. It'll see the $300 that's been reimbursed by the CHIP coverage, and then it'll reimburse the $350 owing at the 80% that the spousal plan covers. So in this case, it's $280 back to James. His out-of-pocket cost is going to be $70. And again, he can choose to submit that remaining balance to his spending account to get the drug fully covered.
I think we have to check that. I think that's wrong.
Is it?
All right, I think.
Okay.
Don't worry about it right now, but
we can look into it.
Yeah, I'll look into that one.
Perfect. So that's example number 2. Now we'll get into the objection side a bit because it does come up. It's a very unique plan, so we'll help you kind of debunk what you might run into when you're talking about the CHIP plan. So one of the common ones we hear a lot is, the deductible is just too high. How do you expect, my plan members to front $1,000 to get their claims covered through insurance? So I like to use the example of a high-cost drug in this kind of objection. So if we're using a high-cost drug example of $25,000, let's say, which is on the really low end compared to what we saw in that CDIPSI report. But let's use that as an example. So under a traditional plan, we're covering typically at 80% reimbursement. If you take into account the $25,000 drug cost, plus what the plan member would have to pay out of pocket, that 20% difference, that's a $5,000 exposure to the plan member that they would have to pay out of pocket, right? Now, if we're looking at the model of the CGIB CHIP plan, it's covered at 100% once that $1,000 deductible has been satisfied. So the only real financial exposure to the plan member is the $1,000 deductible. And in many cases, that's not even a risk because they can use their spending account to fund the prescription up to the deductible amount anyways. So you've taken the financial exposure amount in this case from $5,000 almost down to $0 to the plan member. So a really good way to kind of position the deductible when you're faced with that objection with a plan sponsor, a really good way to handle that.
And again, that is for an occurring high cost claim once you're in the plan. This is not bringing your high cost claim, just to reiterate.
Yeah. Awesome. Objection number 2, we see this a lot. We hear about this a little bit. The healthcare spending account balances for family, it's not enough compared to a single. A family is going to have more people, more dependents. A single person could, maybe go a little bit further with their spending account dollars. But you can ask the question, do you get more compensation just because you're a plan member with a family? You can use single couple family funding if it is a big concern. We are able to accommodate different allotments based on whether they are a single couple or family. So that's kind of one of the bigger ones. Number 2 would be employee with 7 kids is going to end up short compared to traditional. Again, an HCSA is really just a compensation benefit, and it's not generally based on family size. And an employee wouldn't receive more workplace entitlements just because they have a family, right? So something to keep in mind when you're dealing with that objection as well. And then the last one here, one allotment isn't going to fit our company needs. You can consider different ways of funding the HSA. You can sort it by class. Maybe you have a certain HSA allotment for, an executive class or management or, full-time, part-time employees. You can kind of segment it out that way. Years of service, what departments are employees working in. There's a variety of ways you can really kind of tailor the HSA, and we are pretty flexible in what that looks like as well. Objection number, oh, go ahead, Dave, sorry.
Yeah, I'm just going to answer just kind of a couple of questions.
Sure.
I don't have the total number, but one of the questions was asking how many businesses are in the plan and the total number of members. And I think we're around 35 or 40 groups. I don't know the count. So it's still very new. This is like we've been 1 year, and I know a lot of people have been waiting to see what happens and whether the plan all blows up at renewal or whatever. And obviously it is not. But so it's 35, 40 groups, and I would like, we're talking hundreds of people, not thousands of people. So that's it. And there was another comment just made about members don't always pay the co-pay for high cost drugs. And that's correct. Quite often patient assistance programs, patient support programs, or provincial plans like Trillium and a combination will pay for those. That is true. But when we talk about high cost drugs, it is not just single drugs, but it's also cumulative drugs, right? So if you had somebody who has high blood pressure and diabetic and taking cholesterol drugs and something else, none of those may be high cost. They may be $5,000 or $6,000, but cumulatively they're adding up to larger amounts. So it really depends on case by case. And I think that's it. Go ahead.
That sums it up well. Objection number 3, it's different. It's not like a traditional plan. How am I supposed to position something like this? I think that's exactly why we should be talking about it. And again, kind of tying back to the competitive job market we're in now, employers are looking for a competitive edge, right? Competitive edge to attract and retain new talent. That's exactly why we should be talking about a program like this. They actually, employees might actually receive less in a traditional plan because they're not always going to get coverage in there that appeals to them, right? They're always, going to be subject to like limits and maximums, and for certain services that they may see more value in than others. And a traditional plan could end up costing more because you're going to have the people that are really needing it. That's going to drive the costs over time versus the people that aren't really seeing the value in it. So with CHIP, you're actually paying for what's really being used here.
And let's add one more to that list, maybe. If it's not used, it's not paid for. So in a traditional plan, you'd be paying the premium throughout the year and you'd have lower rates in the coming year. In a health spending account, this is everybody's. If it's not spent, it's not billed, or pretty much everybody's. So if you have an employer put in a $3,000 health spending account and everybody spends $1,000, well, the $2,000 stays in their pocket. So that's one of the other pluses to not quite being a traditional plan. You're paying for what's being used. You're getting back what the employer is not paying for what's not being used.
Awesome. Number 4, auto coordination is complicated. How is the plan member ever going to understand how auto coordination works? Now we got to keep in mind that traditional plans do leverage coordination of benefits, right? An HSA would still coordinate the same way with a traditional program, regardless of whether it was a catastrophic program or more of a traditional type model. Coordination is happening all the time, so there's nothing new here. Family coverage with spousal benefits, obviously we let the spousal benefits plan, that's going to be the second payer here, and we're going to keep the HSA coordination off. And we have developed some resources and we've made them available on the CGIB member zone just to help explain these concepts in a little more detail and just provide you with some sales tools when you're talking to your prospects. Objection number 5, I don't want my claims declined at the pharmacy. as mentioned, like, there's that verbiage that comes up now. It actually used to just be an outright decline with no verbiage or very little verbiage. But we've worked with Green Shield on the back end to, at least when the deductible hasn't been satisfied, let the plan member know, how they can get their claim covered. So we've updated the wording there. And the claims are going to be covered when that auto coordination with the healthcare spending account is on, right? It's just going to be a little more streamlined, a little more straightforward. And also for claims that aren't covered through the catastrophic insurance component, so your dental, massage, vision, those types of expenses. And we're typically out of pocket with other service providers too. Like if we go to the dentist, it's typically out of pocket before you're reimbursed. So nothing new here as well. So we're going to get into a little bit of field underwriting now. And I think that field underwriting is critical to ensuring the success and sustainability of the pool, and just making sure, like, if the plan sponsor is going to be a right fit for this type of solution. So if we're looking at virgin cases, these are the types of questions that you may want to consider. So one of the big ones is, why are we having this conversation today? Why are you looking to implement a group plan? What's driving the need? Find out their true motives behind the plan. Is it someone that's going to be needing a high cost drug? Is it someone that is looking to offer a competitive edge? Are they having troubles with attracting and retaining? Asking those questions up front will kind of help you get a better understanding of, is this group going to be a good fit for the pool? Are all employees actively at work is another one you can ask. And I know typically we've had some advisors come back and say, well, for a virgin group, how am I supposed to know if there's any kind of, suspicious activity on a benefit plan, high cost claims happening, or, I don't have any data to rely on if it's a virgin group. By asking the right questions and just saying, like, is there anybody off due to disability? What's the cause of disability? Why are they off? You're able to kind of drill down and get a little more information there, and really, again, help assess whether they're going to be a right fit for this pool.
Can I just stop in? I'm just going to answer one question that was asked about commission, and I don't think we have that anywhere in here. The catastrophic coverage, the CHIP plan itself, has a fixed 10% commission. You cannot change that. That's the same in every province across the country. The health spending account, I believe, is fixed at 4%. But pooled benefits, and you can add, as we said, life and short long-term disability, CI, AD&D, EAP, whatever else you want to add that BBD sells. And those you can set the commission at anything. So I have a case that's a little bit larger. So what we're actually doing is we're kind of looking at the numbers. We're going to have that catastrophic 10, but instead of the life and disability being at 10, we might drop it down to 9 or 8% because it's a larger group. So it allows you the flexibility to still adjust things. And okay, so I need to understand one question that's been asked a little bit better. Trying to think if we could eliminate the rejection point. I know a lot of people live from paycheck to paychecks and hate paying anything out of pocket, and I get that. But there's no way to instantly adjudicate a claim back into your bank account in a health spending account today because of the overnight bank push. So it's kind of an overnight calculation and then an overnight bank push. So it's always 2 days. I don't think there's ever a way to resolve that. The easiest way to do it, and what most of us do, put it on your credit card. You've got the money back in your bank account, say 3 days later, put the money towards your credit card right away. And so you're getting the points for it and you're getting it resolved at the same time.
Awesome. Thanks, Dave. So just getting back into the questions again for asking virgin groups when you're doing that initial discovery, what's turnover like? How often are employees churning here? It's another good indicator of whether this group is going to be a good fit for the pool. And then one of the last questions, I mean, certainly this isn't the only questions you can ask. There's a million questions you could ask. But, what does your ideal plan look like? What do you want your plan to do for you? What does the perfect plan look like? And why are those coverages important to your organization, right? So really getting down to the bottom of why are we talking today?
And I believe there's a huge lack of of understanding of field underwriting. When I started in the business 25 years ago, if you were contracted with an insurance company or a TPA, they would give you a field underwriting manual that said, these are the industries we will quote. These are the ones that we won't. We won't do family content. We won't do average age over 55. Like, there's all these rules. And they helped you to kind of guide to finding the right fit for that insurance company, their products, and so on. That seems to have been lost in about 2001, 2002, so 20 years ago. The last field underwriting book that came out that I've been able to find. We haven't seen anything since. So I think advisors have kind of lost that I don't know, ability or whatever to ask the good questions. And so a lot of people tend to be order takers and just go, hey, you want to put a plan in place today? You got 30 people. Hey, have I got a solution for you? Without asking that big question of, why are you putting the plan in place? Because a lot of the time it's like, oh, well, I got 2 guys on disability and I want them to get paid. And I've got somebody else who's got a high cost drug claim and I want that paid. And by asking a few questions, you're going to save a lot of headache, because if you put it in and it's all declines all over the place, then you're going to end up with a bunch of problems. And go ahead there. I'm going to answer some of these questions in the chat side. So
sounds good. So now we get into like the second part of this. So because you're going to come across prospects that have current coverage, maybe looking to do something a little bit different. So, some questions you could ask for those groups with current coverage: what does the claims activity look like, right? So are the high cost drug claims, are they ongoing? Are they recurring? Are they one-time claims? Or is it parameds and other services that are driving the claims experience? So that'll help you really get a good picture of, again, are they going to be a good fit? Is this the right risk that we want to be taking on? Obviously, you want to get a good understanding of what's working with the current plan and what's not, and how to change that. Dave?
I'm getting a real echo from you. Is there any chance you've got 2 microphones or 2 speakers turned on?
Nope, I haven't changed anything.
Oh, okay. Might just be me.
Maybe it's the internet. Yeah, so another question that you'd want to ask there, and then another question would be, what are your biggest concerns about your current plan, right? So where do you think things could go off the rails? Let's talk about, the stability or the future of your program, right? So another kind of question that you'd want to ask. And what are you looking to change most about the coverage? Why are we meeting today? What's driving the
okay?
Need
Stop.
to meet? Yeah.
Everybody's hearing your echo now. So can you shut off your speaker maybe, and then try again? So just your speaker, not your microphone.
Yep. Anything there?
No, still. And you don't. Sorry. When you hit your speaker off, you can't hear me, right?
Yeah, I can't hear you if I turn my speaker off.
You're just doing an echo that's going around. How many slides do we have left?
There's not a lot, just a few.
Okay, it's kind of messy. So can I get you to mute for a minute and I'll do some, and we'll see if we can't come back, if that's okay? Yeah.
Sure. Yep.
Okay, so I don't know where you were because I was answering questions. Sorry, bouncing in too many places. Did you got halfway down the slide, or how far are you? Yeah. So what's working with your current plan? What's not? Try and identify the problems. What are your concerns, and what are you looking to change? And I think a lot of us really don't kind of get into all that stuff. Oh, somebody just said, is your phone anywhere near your computer and stuff, that maybe that's causing it? Who knows? Give us the next slide. Let's pop ahead and we'll get through a little bit more here. So when you're placing a quote, you do have to let BBD know when you send in the quote. So there's still quoting, although we have the quote engine online. So you can end up with pricing. You're still you're sending in an RTQ to obtain the pooled pricing and also to get approval to sell the product. Because obviously, if you send in claims experience with a current plan with high cost claims, that's going to be declined just like it would be with anybody. So we want to make sure that what you're doing is sellable. The calculator is just a tool to help you do the math and work with the numbers to talk to the client, or just for yourself, for example. quotes go to quotes@bbd.ca. And again, just open it up with, I'm a CGIB advisor and want a quote. So to wrap things up, this is a unique product. The product's been around for over 25 years now in different forms. It was Aetna Flex in a box, became a Canada Life mutual life product, and BBD's been running it for, I'm going to say 20 years or so. Just a different way of doing things. It's kind of just, it's offering benefits in a unique way. And as Jordan has mentioned already, part insurance, part compensation. The big key to it is helping clients to understand it. And that's a bit of a challenge, because if they've always had traditional plans, 80% co-insurance, they're expecting more of the same. This is different. It's 100% co-insurance. And I can tell you firsthand, I have one of my bigger clients. Their HR person said, this is a terrible plan. There's no drug coverage. And I'm like, really? You have 100% drug coverage with no limit? That's one of the best in Canada. And they're like, well, no, we have $1,000 deductible. I go, no, that's true. But beyond that, you have 100% with no limit. How many plans in Canada are 100% drug coverage with no limit? And it takes that kind of extra conversation and stuff around the end of it all. Can you share the cost of the plan, please? Just popped up as a question. It's all on the CGIB site, and it's also in the renewal document that is on the public CGIB site, and some's under plan members, so you can check it all out there for whichever provinces matter for you, and old rates and new rates are there as well. The other thing is, I mean, we're really trying to offer flexibility, which is, as Jordan said, a key thing these days, as people are trying to appeal to employees' needs. So that health spending account really gives that flexibility. It can be used for the deductible, but it can be, used for almost anything else, that CRA allows, obviously. So each employee gets to, figure out how they want to use their money. So if it's all for dental, hey, you can use it all for dental. If you want to use it for deductible and all for massage, feel free. So that's kind of how that works. And overall, it's not a complicated conversation. It's just different. So you want to just kind of try and keep it simple and go, we're covering insurance for the insurable. We're covering health spending account for the day-to-day. It is really, really quite simple. Is there a final page on here, Jordan? Nope. Okay. So questions. Jordan, you can unmute and we'll see how you're sounding. I am just looking back. I'm going to read out a few questions here. I don't know if everybody can see all of them yet, but talking about the declines, is there a way to eliminate that decline process? No. An employee has to be told if a claim has been declined, so that they know that their deductible is being fulfilled. So that process has to be there. Beyond that, it's a bit of a system limitation issue that we have to have a standard message. So that standard message of your claim is declined and eligible for HSA. We can't say it will be paid for by HSA, because if you turn off auto coordinate, it won't be. So we need a kind of a standardized message in there. So that's that. And
there's one on the admin fee here for the spending account. Am I still echoing also?
Oh yeah, brutal. Yeah. I don't know what else to say other than the mute thing. So the admin fee for the health spending account is 12%. 8% goes to BBD and Green Shield, 4% is your commission. It's fixed, it can't be changed. I think. Now I can't remember. Yeah, it's fixed. As new groups are added mid-year, given a pooled rate guaranteed for at least 12 months. So if a group is added in June, do they see the pooled increase in September? No, they see it the next year after the renewal. So the renewal, okay, so it would be, okay, what is it, a 15-month first year? Yeah, so that you'd see it on the cycle after that. With Rupert's medical case management, second opinions be included. What about private pay MRIs? So anything that CRA will allow. So in general, you can use your health spending account to pay for insurance, for healthcare insurance, like a Blue Cross or individual product. You can use it for tests and stuff that are not covered by OHIP. You can use it for anything that CRA allows. And so Ray, I'll refer you back to IT 519 R2, the income tax bulletin, which is now S1 F1 C1, and that gives you the full line of what's eligible and what's not. I'm not 100% sure, because I remember going through this with like the Medicis programs and executive health and things like that. I'm just not 100% sure off the top of my head, so I'd have to look it up. And I think there was one other question. And I got all these echo ones on here, so I think that's that one. Any other last questions people have just before we finish up here? Can we use my HSA? Yes, it's not as smooth. Yeah, you end up having to do that double adjudication. You would save potentially 2% commission, but you end up going through a whole bunch more hurdles. And you got to make sure that the employees know after they finish getting their money back from HSA, my HSA, if they did that, they also have to submit it to Green Shield otherwise, or hold on to that receipt. Otherwise, they're never going to get coverage when they need it, and the catastrophic won't kick in. So that's the reason we kind of suggest. I love my HSA, don't get me wrong, but I would not suggest doing it. It kind of, it's not quite as smooth. That's all the questions we have, I think. And we're just before 2 o'clock, so not a bad spot to stop. If you have other questions around quoting, plan design, usage, case studies, I'm going to refer you, if you're not a CGIB member, there's basic information on the CGIB.ca website. If you are a CGIB member, everything is on the members only page. Just sign in, and there's everything from pricing and examples, handouts to share, case studies to share, the single family documents that that Jordan showed. All of those are there, so you can download them and use them with your clients. If you're not a member of CGIB and you want access to this product, become a member. Go online, cgib.ca, and a day after you're a member, you can start getting quotes. And just to give people like a bit of a heads up, I've been kind of planning my projects over the coming years. This one is off to a great start, and obviously I'm not going to walk away from it. We'll keep monitoring and staying involved. But the next product that we're going to come out with, I hope, if I can find a willing partner like BVD or somebody else, is a fully pooled traditional style plan, 2 to 10, 2 to 20 employees, truly fully pooled. Might be with an exclusionary formulary on high cost drugs to protect. I'm not sure just yet. So there's more and more reasons to be a CGIB member, and that will be kept to members only to kind of keep a bit of control through the whole process. So thank you all very much. Jordan and his echo, which makes him sound like the reverb king of Canada. Thanks you very much. Reach out to your BBD account rep. If you don't have a BBD account rep, reach out to Jordan or me. We can connect you to the one in your area or your province. And anything else you want to add, Jordan? No? Jordan's good? Yeah? Okay. Okay, thank you very much. Have a wonderful day, and may the sales be with you.